So when those spot Bitcoin ETFs finally launched back in January 2024, it was more than just a new product, right? It was a huge signal. A signal that a lot of people believe sets Bitcoin on the exact same trajectory that gold took after its own ETF launched way back in 2004. So the real question is Bitcoin just replaying gold's greatest hits, but on fast forward?
There's this really powerful idea floating around, and it's called the gold analog. It basically suggests that to understand where Bitcoin is headed, all we really need to do is look at gold's history. And it's this fascinating theory that implies history isn't just rhyming, it's repeating itself, just at, hyperspeed.
Okay, so before we get ahead of ourselves and look into the future, we gotta rewind. We have to understand the past. We're gonna unpack the original playbook, the financialization of gold, which really kicked off way back in November 2004 and totally set the stage for the decade that followed. So before this ETF came along, trying to get exposure to gold, it was a real pain, a total headache. You either had to deal with actual physical bars, which meant storage fees, insurance costs, or you had to navigate these super complicated futures markets. And then boom, the SPDR Gold Trust, ticker GLD, it just changed everything. All of a sudden, investing in gold became as simple as buying a share of stock, and that one single innovation completely unlocked the market for a huge wave of new capital. But gold's path wasn't just a straight line up. Oh no, it was this wild, dramatic 10-year cycle. Let me break it down for you. First, you had what they call the validation phase, just a slow, steady 40% climb as big institutions got comfortable with this new way to own gold. Then, bam, the 2008 crisis hits, triggering a pretty brutal 30% crash as investors sold everything they could for cash. That was followed by the manic run, and I mean this was a massive 180% surge as the Fed started printing money. And finally, you get the hangover, a pretty rough 40% correction when the party ended. After a full decade of all that turbulence, gold was still up 165%. Not bad. All right, so that's the blueprint, that's the playbook gold wrote. Now let's switch gears and look at Bitcoin and see how it's replaying this exact same script, but with the fast forward button jammed down. I mean, just look at the sheer speed of adoption. To get to $10 billion in assets, the main gold ETF, it took them about 3 years. BlackRock's Bitcoin ETF, IBIT, it did it in 50 days. What took gold years, Bitcoin got done in under 2 months. That just shows you the incredible velocity of capital in today's digital world. And, the effect on the price, just as dramatic. In its first year post-ETF, gold had a totally respectable 9.1% gain. But Bitcoin? A mind-blowing 120% surge in that same amount of time. It's like it just skipped gold's slow validation phase and jumped right into a supercharged version of the manic run. So for a little while there, it looked like the playbook was holding up perfectly. I mean, line for line. But what happens when this whole analogy faces its first real test? Let's jump forward a bit into a hypothetical scenario. Let's say it's early 2026, and the market throws a massive plot twist that calls the whole digital gold story into question. Okay, so the trigger for this crisis we're imagining, it's a 1-2 punch. First, a more aggressive, hawkish Fed chair gets nominated. Someone who's way more likely to hike interest rates to fight inflation. And that totally spooks the markets, because they're used to easy money. At the exact same time, global geopolitical tensions are flaring up. So this is it. This is the moment of truth. Is Bitcoin going to act like a safe haven the way gold is supposed to? And the answer in this scenario was a loud, definitive no. The second the pressure hit, their paths just split apart dramatically. Gold, the classic safe haven, it soars to record highs as investors run for safety. Bitcoin, on the other hand, it absolutely plummets. It wasn't behaving like digital gold at all. It was acting like a super volatile, high-risk tech stock. In fact, its correlation to the VIX, which people call the stock market's fear gauge, it hits a record 0.88. Now, a high correlation like that just means it was trading almost in perfect lockstep with fear. So whenever the broader market got nervous, algorithms were just automatically selling it off. Bitcoin was suddenly facing a full-blown identity crisis. Okay, so does this hypothetical crisis mean the whole gold analog is broken? Is the comparison totally useless? Well, not so fast. It just means we need to look at it with a bit more nuance, because the story definitely isn't over yet.
So analysts who use these things called fractal models, which basically look for repeating patterns in history, they believe the analog still gives us a really useful framework. They'd argue that our hypothetical 2026 crash was just Bitcoin's version of gold's 2008 liquidity crisis, a totally gut-wrenching but necessary reset before the next huge move up. And their base case projections, they're still looking at Bitcoin hitting something like $220,000 by 2028. And a big driver for that is the next halving. That's the pre-programmed event that literally cuts the creation of new Bitcoin in half, making the asset that much scarcer.
Okay, so what is the big takeaway here? Why does Bitcoin seem to follow the same general direction as gold, but everything is just so much faster, so much more volatile, with these crazy divergences? Why isn't it a perfect one-to-one copy?
Well, the fundamental reason really comes down to their basic economic DNA, their physics. See, gold has what you'd call an elastic supply. When the price of gold goes up, it becomes more profitable to go out and mine more of it. That increases the supply, and it acts as a kind of natural brake on the price. Bitcoin, its supply is perfectly, absolutely fixed by its code. It doesn't matter if the price goes to $1 million or $10, you simply cannot make more of it. And that is what fuels its insane volatility, both up and down.
And this right here, this is the key insight. The gold analog isn't some precise turn-by-turn map that's going to predict every twist and turn. Think of it more like a compass. It just points in the general direction of travel, towards monetization, towards institutional adoption, and towards becoming a major financial asset. But the path to get there? Yeah, that is guaranteed to be a much, much wilder ride.
So, maybe digital gold just doesn't quite cut it. Maybe we need a new term to really capture its unique nature, something like financialized velocity. It's a term that reflects this incredibly scarce asset that was born in the digital age and moves at the speed of information itself. And I think that's the real takeaway here. Understanding this difference isn't just about trying to predict a price, it's about setting our expectations for the journey. It's going to be rough, for sure, but the destination seems to be the same. A new, incredibly powerful, and unpredictable asset class on the global stage.